Li approfondiamo con i gestori, andremo a capire quali sono le loro strategie per quest'anno e anche quale ruolo in portafoglio per le diverse strategie, i diversi comparti. Iniziamo con il Principia Fund di Edge Invest, quindi con Marc Chapman che è il gestore, che invito sul palco. Welcome Marc.
Thanks.
Benvenuto. Allora, Marc, let's start talking European equities. Now, after a couple of years that we've seen, the US market overperform the European equities. Year to date, there's money pouring into European equities from all the rest of the world. And do you think this is a sustainable trend? What's going to happen? Will this year European equities eventually do better than Wall Street and the US equities?
Okay. Well, in the first instance, in terms of demand for risky assets, because the interest rate on cash is so low, there'll generally be continuous demand growth for equities in US and in Europe. Now, if we look at the history of what's happened in the US since the financial crisis, they've adjusted well. The economy started growing nicely. The cyclical sectors such as construction, real estate, general output have all been growing quite well, and that's meant that confidence is built around the US economy. And so US equities have been considered safe and have become a consensus long name for international funds who are interested in equity investing. Now, the opposite has happened in Europe. There's been several crises, starting with the financial one, then double dip, then geopolitical risk linked to Greece, Ukraine. So all of these issues have meant that the risk premium on Europe has been very high, and international investors have been deterred from investing back into Europe for quite a while. As you say, recently it's turned, but it's only just started turning. The macro data is now starting to look better in Europe. In particular, Spain and Germany are starting to perform well. Germany because of its industrial output, Spain because of the restructuring they've been doing. We think France is stabilizing, Italy's stabilizing. And in general, we would say the European economy looks like its growth path is more steady now. So in terms of economic surprise, there's far more potential for surprises on the upside from Europe than the US, where the US has been a consensus long now, and estimates are full and the market's very relaxed. Europe has been the opposite. So I think despite the short-term outperformance, Europe should continue to outperform based on good macro data and also attractive valuations. Large cap European stocks can yield 3 or 4% in dividend terms, which is attractive compared to zero in a bond and maybe 2% in the US. So in absolute terms, relative to other asset classes, it's an attractive area to be looking at, we think.
Well, this is a supportive general economic situation in Europe, but in the end, you don't buy macro, you buy stocks. So what's your sense of if there will be an impact on the EPS and earnings of European companies? And what's the general sentiment of the CEO you're meeting and you're talking with?
Well, from my perspective, the key driver is the consensus earnings estimates going forward. So aside from the discount rate, which comes from the bond market, for the equity market, it's all about the path of earnings and whether consensus is too optimistic or too pessimistic. So if we look at the path of those, if you go back to the start of 2014, consensus estimates for growth were too optimistic. So people were expecting too much of a European recovery. And then after the first quarter and the second quarter earnings numbers, they got disappointed and they started revising down their estimates. So the earnings path was downward from the first quarter of 2014 onwards until the end of 2014. Now looking at 2015, it seems now that consensus earnings estimates are more reasonable for the European universe. People are expecting some improvement based on a little bit of top-line growth, but not excessively so. And then the recent events, so the oil price decline and the euro, are both benefits for the underlying earnings growth. So the euro depreciation helps underpin the growth in international companies. It's quite an aggressive move, and it's benefiting substantially companies with earnings in dollars. And then the oil price decrease is basically a reduction of tax on the consumer and generally helps sentiment. So overall, the earnings path looks well underpinned by the slight macro improvement, but also the favorable moves in the euro and the commodity prices. So the market's looking for about 10% EPS growth for the European market in 2015, and we think that's reasonable. So in terms of missing the estimates, we think there's less chance in 2015 than there was in 2014 of earnings estimates coming in below what people expect. And then from the company meetings that I do, I obviously travel around Europe seeing lots of companies. I've been in Germany recently. The sentiment there from the CEOs is quite optimistic. I mean, they've been quite positive for a while because Germany's benefited from a strong automotive market. Automotive's been strong in the US, it's been okay in Asia, and it's recently improving in Europe. And then industrial output is obviously growing well there, and the euro is a big benefit for Germany. In France, which is more interesting, because France was one of the worst places in 2014, because the macro was very negative. From the conversations I've had with companies there, it seems like the macro is not deteriorating any further. So for instance, we know an online company called So Local, which basically sells advertising space to small and mid-sized companies. And so they have a good feel for what's happening at a local level in terms of how many small companies are being created and destroyed. And 2014 was bad in France. It was basically the structural problems weren't going away. This year, it seems like it's improving off a low base. So France, which has been the more difficult part of Europe, is stabilizing, while Germany and Spain are doing well. So we think with these factors in place, the earnings estimates could potentially exceed what people think, which would be the first time for a while that that's happened in Europe.
What will it make in terms of valuation, this 10% of EPS growth that you're expecting? And do you think that the euro devaluation can go further and we might see parity between the euro and the dollar by year end? What the impact might be on the company numbers?
I think parity is probably unlikely. I think the euro's decreased sufficiently for now. But the move it's had already is a substantial benefit to companies with dollar earnings. So the upside just from the currency, aside from anything else, is substantial for a lot of large cap European companies. And so the forward valuation of Europe is about 15.5 times earnings, which isn't cheap historically, but it is cheap compared to the alternative assets you can potentially buy. So the historical multiple is maybe an average level. But if you look at every other asset class, property, bonds, US equities, Europe's still attractive from a relative point of view.
Having said that, Marc, what are some of the main ideas that excite you currently? How are you looking at the market? What your next move will be?
Yeah, I mean, aside from all of the macro news, what we try to do is find interest in stocks which are essentially going to grow because of structural characteristics and which have something interesting going on within the company which is going to improve returns. Obviously, the macro can be helpful, but it shouldn't be the main determinant. So this is what we search for across the European universe. So one name I would highlight is Oxford Instruments in the UK. This is a £500 million company listed in London. It's the world leader in making instruments for research into nanotechnology. So nanotechnology research is primarily done in universities and research labs at the moment, but increasingly larger companies are focusing their spend on this area. There's a lot of growth potential in many end markets, which will come through nanotechnology. So for instance, in semiconductors, the trend towards miniaturization, which is a strong megatrend which has to happen, the next leg of that will come through nano research. And in addition, the convergence of chemistry and physics will create a lot of opportunities in bioanalytics, personalized medicine, lots of things which will come in the next decade. The breakthroughs will come through the nano research which is being done now. So increasingly companies like Microsoft and Intel are investing in quantum computing and advanced stage nano instrumentation. So Oxford's the leading player in this space with 50% market share. Short term, there have been specific issues which have brought the valuation down and created an opportunity. In particular, exposure to Japan and Russia. So in Japan, R&D was very high, and they've reorientated R&D towards infrastructure spend recently. And in Russia, demand has declined because the spend there has fallen with the economy. So that's created a profit warning twice in the last 12 months and a big derating of the company. So from the work we've done and speaking to the company quite often, we think earnings estimates are now at a low level and the stock is no longer hot and in favor. It's kind of gone out of favor and derated. Midterm, we think that the marketplace will accelerate, and they will get a large share of that market. Short term, the restructuring they're doing will underpin the current earnings estimates. So we think of the current valuation of 13 times forward earnings, it's very attractive. So we have a target price of £12.50 on a 2-year view. That's assuming a normalised margin and an average earnings multiple. And the share price is now about £7.50. So substantial upside on a 2-year view, assuming a stable economy. So they don't assume Russia comes back. They don't assume that things massively improve. Just a relatively stable economic output will give good opportunities for them.
Other ideas? Other examples?
We think Rheinmetall in Germany is an interesting name. This is an automotive and defence company. Automotive has been going well because it's linked to all the mega trends in automotive, CO2 reduction, movement towards lightweight vehicles, and so its organic growth in automotive has been around 6% for the past few years. The problems have been in defence, so half of the revenue is automotive, half is defence. And defence has been a disaster for the past 12 months. Essentially, everything's gone wrong. So they've been fined for bribery in certain countries. They've had an export ban from the German government put in place. Their highest margin part of defence, ammunitions, has temporarily turned down. And they've been unable to get to break even in some of the other parts. So it's basically been lots of disaster. This happened during 2014. And they warned 3 times. And as they warned, essentially, the valuation reduced substantially. And that meant that in the end, it was just the automotive business that was being valued by the market. Now, from conversations with the company, I now think earnings have troughed and estimates won't go any lower, and sentiment has reached as low as it can go on the stock. So the key part, ammunition, is recovering. They basically launched a comprehensive restructuring of the defence business to improve the rest of it. And the German government are taking it on a case-by-case basis in terms of where they're allowed to export to. So I think now there's a reasonable chance the margins will recover towards a mid-term level of 5 or 6%. In which case the stock can go to 55, 60 euros. It's now about 45. So when I first started looking at it in December, it was around 33 euros. And at that price, essentially the market was just valuing the automotive business. So we try to find names where consensus is quite negative and where sentiment is turned against the company because of maybe several disappointments. But then things are changing. So it's not just a value case. It has to be that the negative points are becoming less negative, not turning, and we think there's an earnings trough appearing. At that point, we think we get interested.
Yeah, these are a couple of investment ideas that you do have for 2015. But tell us also, what did you get wrong in the last 18 months, and what did you learn from that?
Essentially, at a top-down level, we try to flex the gross and net exposure based on sentiment. So if sentiment's very optimistic, we become more defensive with the fund, reduce the longs, reduce the gross exposure, and become more net neutral. And essentially, in terms of our reading of sentiment, we roughly read that correctly, I would say, over the past 24 months. But we weren't aggressive enough at actually instigating these changes in direction. So we made modest changes in net exposure and gross exposure when there should have been more aggressive. That was the main error, I would say. And then on the long book, we've been quite good at identifying good ideas early, but we've been too quick to take profits. And this probably comes from the fact that Europe's been difficult for the last few years, and there's always been a crisis around the corner. So when you have profits, you want to lock them in, because you don't know what's going to happen next. And that's the reason why I'm optimistic on Europe now, because I think people have got too much into this nervous mindset. And I also had that problem as well, so I've sold names which have kept on rising way too early in some cases. So those 2 points, I would say.
Well, we understand your optimism on Europe on this year, but let's assume also that there might be something that changed the situation. First of all, we are starting to hear comments on valuation. We have some indices like the DAX in Germany, which are trading at historic highs, never so high. On the other hand, we've been shown that sooner or later this year, the Fed will start hiking rates in the US. And we've seen how the equity market in the US react to that kind of situation. Do you think there will be an impact also on European equities once the Fed start moving in interest rates? And how the fund will perform if the market gets some get some hits from that?
If there is distress in the market, then typically we'd be able to protect most of the downside. If you look at the performance of the fund relative to the index during times of strain, we protect the downside essentially because ahead of the risks appearing, and when volatility is low, we've added to protection and adopted a defensive stance. And so when risks have actually manifested themselves, we'd be in a relatively defensive position. So we're quite flexible about our gross exposure. So the chart which is shown there shows the monthly returns during times of stress, and that shows relative downside protection. And also during years of extreme stress, 2008 and 2011, the fund was relatively unscathed because we shrunk the gross exposure ahead of this happening. So essentially, if I think that the market's becoming too optimistic, if it becomes very optimistic, then I'll become more defensive, just in case there's a negative reaction from the US tightening. I mean, generally, you would expect a negative reaction short-term in the US and then partially in Europe as that happens. Although mid-term, it's actually healthy that the US can move away from very low rates and can move to more normalized monetary policy. It actually shows that the economy is standing on its own 2 feet without monetary support. So mid-term it's healthy. Short-term there'd be a negative reaction, but we think the downside would be relatively contained.
Are you expecting volatility to grow this year? And what if we see some deep correction or flash crisis as in October 2014? Will that be an opportunity to invest and to enter the market? Or do you think that could be a sign of a turning point on the market?
I would see that as more of an opportunity because valuations, although not cheap, historically, are relatively attractive compared to anything else. So if the yield on cash remains at zero, then a pullback in the equity market, assuming that the earnings path is still believed, is a buying opportunity. A lot of it depends on whether consensus earnings become too optimistic. So like I've said, I think consensus earnings estimates for this year are not too optimistic. They're well underpinned by what's going on. If they became too optimistic, then that would present downside. But aside from that, I'd be looking for pullbacks as entry points into attractively valued European names, both large and small cap. So the large caps benefit from the more macro trends, so the weak euro, the weak oil price, big benefit to international European companies. Small caps more sensitive to the overall local environment. So an upturn in Spain or Italy, they're very sensitive to that. So no particular preference either way, both beneficiaries of the environment at the moment.
Do you think that also correlation might go up if we will see more volatility on the market? And we've seen that we had, and you said at the beginning, we had many crises last year that affected the performance of European equities. Now, till a couple of 3 weeks ago, we've been discussing, about Brexit. Now everyone is very quiet on that, but in a few weeks there will be a new round of negotiation. Do you think that there might be along 2015 an impact of political European situation that might, affect the performance of European equities?
No, I think the political risk is now overstated. I think Europe is ring-fenced from any issues with Greece, and I think an exit, although not beneficial, would not be as negative as it would have been several years ago. I think the rest of the EU is now more unified. And so with ECB activity, I think that holding rates very low, I think that underpins the stability of Europe. So I don't think it'll be knocked off course by geopolitical risk, which will be the first time in a long time that hasn't happened. And that's where the surprise comes from.
All right, Marc, thanks very much.
Thanks a lot.
Grazie, Marc Chapman. Thank you.
Thanks.